ICT. Half of trading YouTube says these concepts are the holy grail. The other half say it's overcomplicated nonsense. But here's the thing. There are verified traders out there stacking millions in payouts with ICT. So I spent days digging through interviews, videos, live breakdowns, hunting for what they actually do. And I found something so interesting. None of them uses 40 concepts. They all keep coming back to the same 3 or 4 combined in the right order. I turned everything into a true operating manual, the 4 building blocks these traders rely on, then a complete strategy that combines all 4 step by step, explained so simply that my 90-year-old neighbor could follow along between her morning coffee and her crossword. And on top of that, I'll tell you how to backtest this whole thing yourself so you never have to take my word for it, or anyone's word for it. Let's get straight to it. For this video, I'm using TradingView. So open a chart on any market you like, because this works on forex, indices, crypto, whatever you trade. Before we touch the strategy, you need to understand the single idea that everything in ICT is built on. The market doesn't move randomly. It moves from liquidity to liquidity. So what is liquidity? Every stop loss sitting in the market is a pending order. When you go long and place your stop below a support, that stop is a sell order waiting to be triggered. Now multiply that by thousands of traders all looking at the same obvious levels, and you get pools of orders resting at very predictable places. There are 2 types. Buy-side liquidity sits above the market. It's the stop losses of short sellers and the buy stops of breakout traders, resting above old highs. Sell-side liquidity sits below the market. The stops of everyone who's long resting below old lows. And the most concentrated pools of all? Equal highs and equal lows. When price touches the same level 2 or 3 times, every textbook says strong resistance or strong support, which means everyone positions around it, and everyone's stops pile up just beyond it. To institutions, that's not a barrier, that's a target. One more distinction that will save you a lot of pain: external versus internal liquidity. External liquidity is the old highs and lows at the edges of a range. Internal liquidity is everything inside the range, like fair value gaps. Here's why it matters. When you're on the right side of the market, price will reliably travel to external liquidity. That's where we'll place our targets later. And one rule to tattoo somewhere visible: professionals only act on this when they have real conviction about which pool the market is drawn to. If the chart looks 50-50, they close it and check another market. No clear target, no trade. Now, bridge number 1. If the market travels from pool to pool, we need a way to know when it's changing direction. That's market structure. In an uptrend, price takes higher highs and higher lows. Every time a previous high gets broken with a candle close, that's a break of structure, a BOS, and it tells us the trend is continuing. Wicks don't count. We need the body to close beyond the level. But the signal we care about most in this strategy is the opposite one, the change of character, or chalk. That's when price breaks the wrong swing. In an uptrend, instead of breaking the previous high, price closes below the previous high or low. The character of the market has changed. Buyers were in control and now they're not. And here's a detail that separates a real chalk from a fake one. Before the break, look at what price failed to do. If the uptrend tried to make a new higher high and couldn't, printing a lower high first, and only then broke the low, that's a much stronger reversal signal. The trend showed weakness before breaking. Third building block, and this is where our entries will come from, the fair value gap. A fair value gap is a 3-candle pattern. When the market moves so aggressively in one direction that the wick of candle 1 and the wick of candle 3 don't overlap, it leaves a gap in the middle. Price moved so fast that one side of the market never got a fair chance to participate. These gaps act like magnets. Price loves to come back, fill them, and then continue in the original direction. That's why a fresh fair value gap left behind by a strong move is one of the best entry zones in all of ICT. You're not chasing the move, you're waiting for the market to come back to you. Quick quality filter. The best gaps are fresh, meaning untested. They're large, because a bigger gap means a more aggressive imbalance. And they form right after a structural break, because that's institutional money leaving a footprint. Last piece of theory, and it's the one that glues everything together. ICT describes market moves in 3 phases: accumulation, manipulation, distribution. First, the market goes quiet and builds a range, accumulation. Then it does something cruel. It breaks out in the wrong direction, just far enough to sweep the liquidity resting beyond the range. That's manipulation. And once the stops have been collected, the real move begins, distribution. Read that again, because this is the engine of our whole strategy. The fake move comes first. The sweep is not a failure of your analysis. The sweep is the signal. And these sequences don't happen at random hours. They cluster around the sessions with real volume, London Open and New York Open. Trade the same setup at 3 in the afternoon on a dead market, and don't be surprised when nothing follows through. Alright, theory done. Now let's turn these 4 blocks into one repeatable strategy. I'll show it manually first, because if you can't do it by hand, no indicator will save you. There are 4 steps, and all 4 must be present. Skip one, and congratulations, you've just invented a brand new strategy. It's called donating to hedge funds. Step 1. Start on your higher time frame. The 1 hour works great. And mark the obvious pools: equal highs, equal lows, the previous day's high and low. Then ask one question: where is the external liquidity this market is most likely drawn to? That level is your target, and it's a prerequisite, not a detail. Without an opposing pool pulling price, the whole setup has nowhere to go. Remember the theory: no clear target, no trade. Step 2. Wait for the manipulation. Price has to run into one of those pools on the opposite side of your target and take it out. For a long setup, you want price to dip below equal lows or below an old swing low. And here's the rule that matters: you want a sweep, not a breakout. The wick takes the level, but the candle does not close beyond it with conviction. If price closes cleanly through the level and keeps going, that's not manipulation. That's distribution in the other direction. Stand aside. And best case, this sweep happens during London or New York Open, inside the windows we covered in the theory. Step 3. Wait for the change of character. The sweep alone is not an entry, ever. After the sweep, drop to your execution time frame, the 5-minute or 15-minute, and wait for price to close through the last opposing swing with displacement. Displacement means big-bodied candles, an aggressive move, not a slow drift. And remember the upgrade from the theory. If price printed a higher low before breaking that swing high, showing that sellers were already exhausted, you're looking at the strongest version of this signal. Step 4. Enter on the fair value gap. That displacement move will almost always leave a fresh fair value gap behind. That gap is your entry. Set a limit order inside it and put your stop just beyond the swing that made the sweep, because if price trades back through that point, the whole idea is wrong anyway. Your final target is the external liquidity pool from step 1, and for management, I'm borrowing the rule that a verified 8-figure trader swears by. When price hits 2R, take half off and move your stop to break even. From there, the runner does the work, and you're in a risk-free trade. That's the entire strategy. Sweep, shift, gap. Everything else is patience. Let me show you the whole thing in action. We're on NQ, 1-minute chart, and the clock just hit 9:30, the New York Open. Step 1 was done before the bell. Above us sits the buy side resting over yesterday's high. That's my draw. And below us, there's this low from the pre-market session. Now watch what the open does. First move is straight down. Price is driving into that low. The wick is poking below it. And this candle cannot close down there. That's the manipulation. The stops below just got collected. Now I need the shift. Look at this series of red candles that pushed us down. For a valid change of character, I need a candle body to close above all of them. Price is turning. One candle up. And there it is. This candle just closed clean above the entire series. And it did it with displacement. One aggressive bodied candle, no hesitation. And look at what that move left behind. A fresh fair value gap right below us. So here's the trade. Limit order inside the gap. Stop below the low of the manipulation, because if price trades back down there, the whole idea is dead. And target on the buy side above yesterday's high. Price is pulling back. Order filled. Now patience. There's 2R, half off, stop to break even, and the runner is free. And a few minutes later, there it is. The buy side gets taken and we're out at target. Sweep, shift, gap. That's it. That's the strategy. Now at the start, I promised I'd tell you how to make this strategy yours, and here it is. I've put together a complete free guide on how to backtest any strategy, this one included. Simple, fast, 100% free, and no coding required. You'll find the link down in the description. All I ask in return is a comment telling me why you trade, not the surface answer, the real answer. Freedom, family, proving someone wrong, whatever it is. I read every single one. Now, everything I just did by hand took experience, screen time, and honestly, a tolerance for self-doubt. Was that really a valid sweep? Is that sweep significant enough for a chalk? This is exactly why I use my favorite indicator. I open TradingView, hit the Indicators tab, and type in Price Action Toolkit by Flux Charts. Every single step of this strategy has a dedicated feature in this toolkit. So let me show you how every step gets automated. Open the settings and turn on buy side and sell side liquidity, plus equal highs and equal lows. The toolkit now plots BSL and SSL zones automatically. The pivot length setting controls how significant the levels are. A higher length shows fewer but more important pulls further from price, which is exactly what we want for targets. For equal highs and lows, there's an ATR multiplier from 0.1 to 1.0 that decides how close two highs must be to count as equal. Keep it low for stricter, cleaner levels. In 10 seconds, your whole liquidity map is drawn. No guesswork. For the sweep, enable the liquidity grabs feature. When a candle wicks below a swing low, but the body rejects away from it, a green circle prints on the chart. That's your bullish liquidity grab. Red circles mark the bearish grabs above swing highs. And here's the clever part. The wick body ratio setting decides how strong the rejection must be. Crank it higher and the toolkit only flags the violent sweeps, the ones where the wick dwarfs the body, which are exactly the manipulations we want. No more debating with yourself whether the wick counts. Turn on market structures. The toolkit labels every BOS and every chalk automatically using candle closes exactly like our rule. But here's my favorite part. It also detects the chalk plus, which is that stronger version we talked about, where price fails to make a new higher low before shifting. The toolkit has a dedicated label for it. The swing length setting controls how significant the pivots are. And you can even have candles colored according to the most recent chalk plus, so the current bias is readable at a glance. Finally, enable fair value gaps. Fresh gaps get drawn automatically, and once price fills one, it's handled for you, so you never accidentally trade a stale zone. You can adjust the sensitivity to filter out the tiny gaps and only keep the meaningful ones. And one more thing that changes everything for anyone with a job or a life: the alert section. You can set alerts for buy side and sell side liquidity grabs, for bullish and bearish chalk and chalk plus, and for fresh FVGs, which means you can literally wait for your phone to tell you the sweep happened and the shift confirmed. Open the chart and only then decide. You're not staring at candles for 6 hours hoping for a setup. If you want to use the price action toolkit yourself, the liquidity grab feature is actually available for free on Flux Charts. And if you want the full package with the chalk plus detection, buy side and sell side liquidity zones, volumetric order blocks, and all the alerts, you get 20% off through the link in the description with this code. I earn a commission if you use my link, which helps keep this education free. But understand this, I could have recommended hundreds of other indicators. This is the one I put in front of you because it's the one that actually works. Thanks for watching and see you guys next time.